Hey everybody, welcome back to another dividend investing video. Continuing along with my series on top stocks for 2023 by sector, today we're going to focus on the information technology sector. This is the sector with some of the largest companies in the market, many of which have been beaten down hard over the course of 2022. Many of these companies pay a lower yielding dividend but have high dividend growth, making them ideal investments for the long-term dividend growth investor. I want to highlight three in particular that I will be buying over the course of 2023, and I see these as my top tech stocks for this year and beyond. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Real quick, I wanted to say thanks to all who have subscribed. Help me reach our goal of hitting 10,000 subs before the month of February. Yay! I appreciate all the interactions. This is my first video in over a week. I'm working on getting a more regular schedule, trying to find the right balance as a single dad, working full time and all that. And I thank you so much for being here as I figure this out. And there is lots more to come. Now, to see the overall performance of the technology sector, we just look at Vanguard's Information Technology ETF, VGT. Notice it's down over 12% in the last year. In this video, I'm going to show you what I think are the best ones here to own in 2023 and into 2024 for dividend growth investors. Here are what these stocks have in common. They all beat the S&P 500 on the 5-year and 10-year basis in terms of price performance. Their current PE ratios are either less than or at least in line with their 5-year average, making them reasonably valued relative to themselves. They have a dividend growth track record of at least 10 years. They have an average annual dividend growth rate of 10% over the last 5 years. They have a Simply Safe dividend safety score of 90 or greater. Their shares outstanding are on a 10-year decline, and they also all have strong return on invested capital, all the things we want to see. And without further ado, let's just get into that. Leave a comment down below with your favorite dividend-paying company in the information technology sector for 2023. Where would you put your money if you could only invest in one tech stock? Also, stick around till the end. I've identified 3 additional dividend stocks in the tech sector that I think are going to be solid ones to keep on your watch list throughout the year of 2023. Company number 1, Microsoft, ticker MSFT. Microsoft is in the business of computer software, computer electronics, personal computers, and related services. Headquartered in Redmond, Washington, they are best known for their Windows operating system, Microsoft Office software, and the Xbox video game consoles. Microsoft is the second highest valued company in the world with its $1.8 trillion market cap. Microsoft is also one of 2 companies to have a pristine AAA credit rating, better than that of the US government. Their balance sheet is among the strongest you can find. This is an extremely high quality company. But Microsoft has had a rough last year, down over 18% in that span. It is underperforming the broader market, which is down about 9% over the last year after a strong start to 2023. But zoom out and you will see a stock that has performed extremely strong for investors. The 5-year performance is 162%, crushing the S&P 500's 41% gain. And the 10-year price performance is a mind-blowing 766%, while the S&P is up about 166% over that 10-year time span. Microsoft's valuation, its PE at the time of publishing, is at 24.8. This is about 9.4% lower than its 5-year average of 27.4. And I think any time a company like this of the highest quality is available at a discount to its mean is worth consideration. Microsoft's dividend yield is at 1.12%, trading exactly within its 5-year average. Not a lot of current income, but you don't buy Microsoft for income today. You're buying it for total growth. Microsoft's dividend is paid out quarterly in the months of March, June, September, and December in the amount of 68 cents per share, giving us a total annual payout of $2.72. To get that upcoming March 9th dividend payment, you have to have your shares before February 15th. The dividend takes up 28% of forward earnings and 30% of forward free cash flow. And since 2016, this ratio has been on a steady decline. This is a rock solid dividend. Simply Safe Dividends gives us a safety score of 99. Very safe. The 5-year average annual dividend growth rate is 10% per year with 12 years of consecutive dividend raises. I can't imagine this trend doesn't continue over the next 10 years. Let's look at its historical yield on cost. This is what your shares are paying as a percentage of your initial investment, and this illustrates perfectly why I love stocks like this. The 5-year yield on cost is 3%, and check out this 10-year yield on cost is nearly 10%. That is amazing. For your shares you bought 10 years ago, they'd be giving you 10% of your initial investment. Look at revenue growth. Microsoft is looking fantastic from that point of view as well. In 2013, they brought in $77.8 billion in revenue, and in the last 12 months, we have $203 billion in revenue. Microsoft is also buying back shares every year, with shares outstanding on a nice, slow, steady decline over the last decade. There were 8.47 billion shares outstanding in 2013, and today there are 7.52 billion. And this is one of those charts we prefer to see on the decline because as shares are taken off of the market, the ones that we hold become more valuable. Another metric I like to look at is return on invested capital. How well is management doing at allocating its capital? And Microsoft is crushing it at 34%. Wall Street loves this stock, and 51 analysts rate it a 4.49, which is close to a strong buy. Out of those 51, 3 see it as a hold and 1 as a strong sell. The average analyst price target is $291.36, representing over 20% upside from current levels. Not only do I see this as one of the top tech stocks to own, it is one of the best businesses to own, period. I am buying and will continue to be buying shares of Microsoft throughout the year of 2023. Earlier this month, it was in the 220s, and I really like getting it when it's around that level. But I don't overthink this one. This is just one that I buy and hold. Company number 2, Texas Instruments, ticker TXN. When most people think of Texas Instruments, they think back to the graphing calculators we had to buy in high school. But those calculators are really a very small part of their overall business. Texas Instruments is based out of Dallas, surprise, surprise. And then they design, manufacture, and sell semiconductors to electronics designers and manufacturers all over the globe. This is one of those companies that is low-key involved in your day-to-day life, with a high likelihood that a Texas Instruments chip is in the very device you are using to watch this video about Texas Instruments. This is a company that's been a compounder for investors, and let me show you. Now, Texas Instruments' price performance is nearly flat over the last year, certainly stronger than the broader market. The 5-year performance is 60%, which exceeds the S&P 500 performance, which was at 41%. And they had a very strong 10-year price performance of 425%. This more than doubles what the broader market did over that same stretch. This has been one of the strongest stocks in terms of dividend growth over the same time, which we're going to get to. In terms of valuation, Texas Instruments looks fairly valued right now with its PE of 22.4 being right in line with its 5-year average. Notice over most of 2022 it was trading a little lower, and it was a stock I was buying heavily in 2022, and I'm going to continue to be adding on dips in 2023. Shares of Texas Instruments are yielding 2.8% at the time of publishing. This is about 5% higher than the 5-year norm. I try to buy this one when it's yielding 3% or higher, and you can get it at that yield when Texas Instruments is trading at $165 and below. There have been plenty of chances over the last year to get it at or below that level. Texas Instruments pays its qualified dividend quarterly in the months of February, May, August, and November in the amount of $1.24 per share for a total annual payout of $4.96. Have your shares by January 30th to get the next dividend for February 14th. While the payout ratio has been elevated over the last year, most likely due to increasing costs, the dividend is still easily covered, taking up 63% of forward earnings and 71% of forward free cash flow. Simply Safe Dividends provides us a safety score of 90, very safe. Texas Instruments has one of the strongest dividend growth track records you can find. For the last decade, we have 18 years of consecutive dividend raises, and get this, 60 years without a dividend reduction. The average annual dividend growth rate is 21% over the last 5 years. Texas Instruments is another one that has impressive yield on cost metrics. The yield on cost on shares purchased 5 years ago would be yielding over 4% today. And if you bought your shares 10 years ago, you would have a yield on cost of around 15%. This is why I am a dividend growth investor. We have healthy revenue growth over the last decade. In 2012, Texas Instruments had a $12.8 billion in sales, and in the last 12 months, they've brought in $20.2 billion in revenue. Shares outstanding have been steadily declining. There's 1.1 billion shares outstanding in 2012, and today we have 931 million. Moving along to return on invested capital, Texas Instruments again looking solid at 47% return on invested capital over the last 12 months. Texas Instruments is covered by 32 Wall Street analysts over the last 90 days with an overall rating of 3.42, which is a hold. The average analyst price target is $176.15, which is right in line with its current value. With one of the strongest dividend growth track records of the last decade, I was buying this in my Roth IRA last year and some in another taxable account. And growing a nice position here, I'll definitely be looking to add a share here or there over the course of 2023 on dips, preferably around that 3% yield level, which is close to my own yield on cost. Company number 3, Visa, ticker V. You might be inclined to think of Visa as a financial company in that sector, but really it's a payments technology company. They're not a creditor, they do not act as a bank, but they provide the gateway to facilitate transaction authorization, clearing, and payment settlement. They are best known for their branded Visa credit cards, debit cards, and prepaid cards. Visa is the world's second largest payment organization behind China's UnionPay. It is the dominant payment company in the West, where it handles approximately 50% of all credit card transactions. Over the last year, Visa is actually up nearly 11%, greatly outperforming the broader market. Their 5-year performance is about 79% as opposed to the S&P performance of 41%. And the 10-year performance, extremely solid, 465% price gain over the decade. It really pays to hold compounders like this and the other two we discussed over long periods of time. Visa is the most richly valued out of the three I'm highlighting here. It's trading at a 27.1 forward PE, but this is lower than its 5-year average of 29.2, and we expect a high-quality company like Visa that has been a serious compounder to trade at a premium. Visa is a lower-yielding stock with a 0.8% yield, but this is 27% higher than its 5-year average. And looking at it from that perspective, this could be a decent time to invest in Visa. Visa pays its qualified dividend quarterly in the months of March, June, September, and December in the amount of 45 cents per share for a total annual payout of $1.80. And it looks like an extremely secure dividend. Look at how it only makes up 22% of forward earnings and 18% of forward free cash flow. And you have to love the consistency of these graphs. Simply Safe Dividends gives it a dividend safety score of 99, very safe. And for a low-yielding stock like Visa, this is an amazing dividend growth stock, which speaks volumes about the overall performance of the stock. Growing your dividend at an average rate of 18% year after year, and it rarely goes above a 1% yield. And this is why I own Visa. That's 14 years of dividend growth. The 10-year yield on cost is around 4.5%. And this is the type of company where you'll be making a high yield on cost on your initial investment many years in the future. Revenue growth has been exceptionally strong over the last decade. Visa made $11.8 billion in sales in 2013. And over the last 12 months, they've made $29.3 billion in revenue. The outstanding share count is on a steady decline over the last 10 years. In 2013, there were 2.62 billion shares outstanding, and today there are 2.14 billion shares outstanding. So Visa is buying back shares every single year, and the return on invested capital is exactly what you want to see. At 31%, Visa is killing it. Visa is covered by 35 Wall Street analysts who give it an overall rating of 4.42, which is a buy, edging close to a strong buy. The average analyst price target is $251.44. This represents over 12% upside from its current price. Visa is an attractive company for long-term investors. They are extremely profitable. They carry very little debt. They're a king in their space with the widest moat. And I've been a shareholder for quite a few years myself, and I see myself adding to my position here in 2023. So those are my top 3 picks in the tech sector for dividend growth stocks in 2023. They're the ones I'll be watching, they're ones I already own, and ones I plan to continue increasing my positions in. Really, these are 3 of the best overall businesses amongst my portfolios just in general. As promised, for sticking around and making it to the end, I'm going to share 3 more picks I like for the next year and beyond in the tech sector. put these stocks on your watch list. The first is Broadcom, ticker AVGO. This is similar to Texas Instruments. Their dividend growth has been even more insane, with a 29% 5-year compound annual dividend growth rate. The SimpliSafe dividend score on this one is 67, which is considered safe, but perhaps not as rock solid as the other three we highlighted in this video. And this is one I do own in the public portfolio I am building up here on the channel. I definitely liked it better when it was under $500, back when we highlighted this as a stock at a discount back in November of 2022. And today I think it's really more at fair value. The second tech sector dividend stock to watch is Cisco Systems, ticker CSCO. Today it's available at a 3.17% yield with 11 years of dividend raises. The 5-year average annual dividend growth rate is at 6%, and the SimpliSafe dividend safety score for Cisco is 91. This is good, reliable dividend income. I just bought some Cisco last week and will continue to build this one up. I think it's attractive here with its PE of 13, which is a discount to its 5-year average PE of 15.2. And finally, I think you should keep an eye on automatic data processing, ticker ADP. This one is actually down a little over the last month, about 5%, while most stocks have been on the rise. With ADP, you're getting a 2% yield, with a dividend growth track record of 47 years. In just a few more years, this will be a dividend king. The 5-year average annual dividend growth rate is 13%, with their latest increase announced last November at 20%. This trades at a premium like many strong businesses of this caliber. For me, I am dollar cost averaging into it and slowly building up my position. And that's it, folks. I hope you found this useful. We have several more sectors to cover over the next couple months, so make sure you hit that notification bell to receive alerts for when the next video is up. I'm aiming to have this series wrapped up by Q1, the end of Q1. You can also follow along on my public YouTube portfolio where I've been buying some of these stocks, and I also have a Roth IRA investing series where I'm doing weekly SCHD buys, as well as buying up REITs in that account. And I've got a video coming out next week revealing the REITs I'll be focused on in 2023, so look forward to that. Please check me out on Twitter at DivGrowthIncome. I love connecting with you folks and chatting about all things dividends, and until next time, keep investing.